Good morning, Richard Callahan, Creekside Realty. We're here to talk about Silicon Valley real estate market, both geographically, and that will be the current market conditions, and then graphically going back over time. We'll come back to this slide in a little bit. This slide was a new addition last week, and I just wanted to bring it up for a second week. What it's doing is showing the ratio in the blue line between the expensive areas and the affordable areas, the ratio of their market share. And what's interesting is at the end of every year, which is the bold line here, because the bold line is January 1st, and then the fainter lines are the first, second, and third quarter of the years. So you can see the expensive areas make up a smaller percentage of transactions at the end of the year, which is why the median price, which is the orange line, falls at the end of every year. It's not property values going down every year, it's just the makeup of what is selling and therefore impacting the median price. Here's the first graph that we're looking at. This is days of unsold inventory. Days of unsold inventory is the key indicator because it tells you how quickly the market's moving. Basically, anything between 40 and 80 days I consider to be a balanced marketplace. Typically, Silicon Valley tends to be in a seller's marketplace. If you look at these timeframes, they're all pretty aggressive. They're all basically somewhere around 20 days or less. Yes, there's significant exceptions like the expensive areas in the San Mateo County area, at 129 days. Another area that's pretty far up there is the coast, and Foster City is a real small area, so it fluctuates quite a bit because there isn't large enough size to cause stability. This is important enough that I'm just showing a little bit of history over time. This is going back to basically Christmas. You can see that we were much paler, and then we got even paler right at the beginning part of the year, and now you can see that for the most part we're in fairly solid red color, which would be the fast-paced marketplace. So here's the second graph. I like this graph because it tells you the 75th percentile time on the market for sellers. So I call it the long typical sellers. How long is it taking a seller that's serious about selling? It's not selling right away for whatever reason. Basically, these times are pretty amazing. It's 2 weeks. That means 75% of the sellers are selling in 2 weeks or less. A fair number of those sellers are going to be selling in 1 week or less. But the fact that 75% of your sellers are selling in 2 weeks is pretty aggressive. Again, the big exception here is the San Mateo Coast, where it's taking 71 days to sell. So it's taking 2.5 months for 75% of the sellers to sell. You get down to Pleasanton, you're in the single digits at only 9 days. So that's approaching 1 week. This is looking at the average ask price reductions. So these are price reductions that the seller has taken between the time they listed the property and the time they accepted an offer. These numbers tend to be very stable and very close to 100%. And the reason for that is sellers do a lot of homework before they put their house on the marketplace and pretty much know what market value is. Anything from 99 to 100% I consider to be a red hot marketplace. So basically, sellers taking less than a 1% reduction. You can see most of these areas are right at 100. It's going to be pretty unusual to have something at like 99.2%. But then you can see there are some areas in San Mateo County that are down around 95%. The coast is at 86%. That means sellers are taking on average a 14% price reduction off their original ask price before they get the offer in. Saratoga Las Gatos is a 5%. So the real key, the reason I like this is you don't have to wait until escrow's closed to get some idea where the market is. If the market's super hot, these numbers will be lower, and if the market's super cool, these numbers will be higher. So you can track shifts in the marketplace without waiting for the sale price to get the sale price to list price ratio, which is obviously more important and coming up. This is that ratio. It's the average overbid, and you can see a lot of these areas are above 100%. The only one that I'm seeing that's below 100% is, again, the expensive areas in San Mateo County. I consider anything from 99% to 101.5% to be normal. The reason I'm willing to go over 100% on this one is that buyers have the ability to bid up. It's very rare that a seller will raise their own asking price, so it's going to be very unusual that the list price reduction ever goes over 100%, and that's why they're all bumped up right at 100%. But overbids goes up quite a bit, and again, Oakland Oakland, and then Berkeley and Alameda are doing the best in Alameda County. In general, the further you get away from the job sites, almost the better these numbers are doing, but you can see them yourself. This is the frequency of overbidding, so it tells you how common overbidding is. And you can see in the expensive areas in San Mateo County, it's very low at 20%. Now, in a lot of areas of the country, they might think 1 out of 5 sellers getting more than they're asking. What do you mean that's a bad marketplace? We're used to being up around 2/3 of the sellers getting more than their asking price, and you can see that a lot of these numbers are in the 40 percentile for some of the slower areas, and a lot of them are in 2/3, and some are up at 3/4 of the sellers are getting more than their asking price. So buyers are not afraid to overbid a property if they want it and if it's priced right. Now we're looking at the appreciation of properties since the last 9 months of 2015. So that was a time frame when it turned out prices were pretty stable. And if you can look at it, your job centers right up here in San Mateo County have done the worst. Why? Because those are the areas that are doing the worst currently, and that's going to be almost always the way it is. Anytime you look at appreciation over a period of time, the areas that are doing the best in the recent years are going to have the best over the whole long period of time. The areas that are doing worse right now are going to have the worst appreciation over the long term, and that's just because the compounding. If you start off at 100% and you appreciate to 150%, and then you get 10% appreciation on top of that, you're at 165%. The areas that are only getting 7 or 8% now start lagging behind. So you can see the numbers range. I think the low is about 134% and the high is somewhere around 188% in Pleasanton. And you can see the East Bay is doing pretty strong over here. Livermore, here's Pleasanton. You can even see things like South County, where you get a little bit more land for your money, is doing relatively well on the appreciation. This is sold price. I have 3 numbers here. The first is the 10 percentile, so that would be the lowest 10% in a geographical region. The middle number is the median, and that's what the color is assigned by. And then the right number is the most expensive 90 percentile you'd find in a given market area. So you can again see the expensive areas are along the west portion of Santa Clara County and San Mateo County. The inexpensive areas are along the east in Alameda County and even in Santa Clara County. Basically, the rule of thumb as you go south and east, the prices tend to become more affordable. Here's a recap of what we looked at. So here are your micro market areas over on the left-hand side for the 3 counties that make up Silicon Valley. Then you have the same order that we went over: days on sold inventory, days on market, price reductions, overbids, frequency of overbidding, the appreciation, and then the sold price. So you can either start on your affordability index over here on the right, or you can start in the areas you want and find out what the market conditions are by using this one table. This is taking the asking price ratio distribution of every week, and some of the key points to keep in mind. I'm only looking at the 17.5% of the sellers that are taking the biggest price reductions, and that's because the vast majority of the sellers don't do any price reductions whatsoever, and the far extreme is the only place where there's any movement. You can see you're up here on the dotted line. A very good year, the best year you can possibly have, is everybody at 100%, because as I've already explained, you're not going to get 101% of the seller's asking price, especially on an average, but this is over the whole spectrum. And I exclude typos. For example, I had a corrected listing on this week where it was originally listed for $1,000, and then within a few hours they raised the price to the real asking price of $425. It's just a data error. So I correct all those that I catch, and usually I catch the vast majority of them. Anyway, if you have the blue down arrow, the market's cooling. If you have the red up arrow, the market's improving. Each line is a different week. We start a year ago, we go up to 3 months back, and then we flip over to weekly increments. So you can see that's a significant decrease, another decrease, and I'm bolded it so you can see it at a small decrease, an increase, a decrease, a small decrease, real small. Now we're going to go up for several weeks in a row, and we're at 11 weeks right now. You can see we have a little plateau, another improvement. And right now, for the next 5 weeks, we're sort of bouncing around. I don't know if to call the whole thing a plateau or not, but you can see that you haven't really moved much. And that's the seller's price reductions. Basically, again, the huge advantage of this is if the market starts slowing down, it's my belief, and I believe the data shows this, that this curve will start moving down to the right to the dotted line down here, which is the worst week in recent history. Now, we did have a worse year way down here that barely made it on the graph. And I think that was February of 2008. And I should verify that just so I know. Now we're shifting over to my longer term property, which shows the overbidding. The disadvantage of this graph is you have to wait for the buyers to come in and bid on the property and the sold price to be released, which means you have to wait for the period of escrow. Basically, the worst week we ever had was down here, which was way back on November 30th of 2001 after the World Trade Center. The best week we ever had was just a little over a year ago on March 29th, 2022. And it doesn't matter what data you use, because when I had Contra Costa County data added into Silicon Valley, it got delayed to, I think, April the 16th of, so basically a little over a 2-week delay, probably a 3-week delay in what happened to the overall area. And the other major takeaway with the shift in the market that we saw in that second slide with the affordable and expensive ratios, you can't look at what's happening in the median price and say that's what's happening right now in any given area. Median price reflects on the entire marketplace. So that's why I think it's so important to look at micro market data. Anyway, we'll step through 11 months ago. You see we're coming down 9 months, 8 months, and stepping down. Now we hit a little bit of a plateau for a couple months. And now we're at 3 months, 12 weeks, and another plateau, but at a lower plateau. And now we're starting to improve. And you can see the improvement is pretty consistent. And the purple's the current week. And the plus 1 week, just so that everybody understands that, is I use a March 1 real estate fiscal year. So I get my data on March 1st, I look back 35 days. Then I move forward 7 days and look back 35 days. I do that all the way up to February 21st. And then on February 21st, I jump forward, not 7 days, but I jump forward to March 1st. Because of that, our weeks end on April 26th, which was Wednesday, and this is next Wednesday. So the purple line is my normal comparing apples and apples, like I really like to try to do. May 3rd is actually only using data for the current year through midnight last night, because that's the most recent data I have. There's not that many new data points, which is why I put it in, called a plus 1 week, and why I put in a dashed line, because that line is going to move a little bit based on what happens between now and next Wednesday, or through Tuesday at midnight, compared to what happened 5 weeks ago during that time frame on the data set that's being eliminated. So each one of those data points is 35 days in my database, but I'm not ending on a Wednesday. I'm ending on a Friday. So that's why I call it plus 1 week. Anyway, the green is what I call my base URL. That gets you to the YouTube archives. If you add 2023, you get to the live presentation Saturday morning at 9 a.m. If you add in the handout, and it is up, my goal is to get it up about 45 minutes early for anybody that wants to print it out. You just put in H, the year, and month, and day. And as I said, it's up. And any specific episode, again, the year, month, day. Do I have any questions from anybody? Not hearing anything, I will proceed. And now what we're doing is we're looking historically over time. So instead of just knowing what the current market is, you have some idea what the trends of the market have been doing. The blue line is the coolest marketplace, the coolest 10%. The gray line is the median, the typical, and the red is the hottest. So we're looking at inventory. So low inventory would be a hot marketplace. So right now, the purple line is the data line. You can see is right on top of the red line, which is the lowest 10 percentile. So basically, we're having a shortage of inventory at this time. You'd expect to be up here almost at 2,500 listings, and instead we're down here somewhere around 1,600. So we're having a shortage of about 900 listings. Now, if you look at the number of offers accepted, the same concept, but now having few offers is a cool marketplace. The typical is still in the middle, and the hot marketplace is a lot of offers. Currently, we're only selling something around 1,800 homes. You'd expect to be selling somewhere around 2,800, call it. So you're selling about 1,000 fewer homes than you would expect to be selling if it was a typical year. So we have very low volume. This is days of unsold inventory. This is where you take a ratio between the supply and demand. Red hot marketplace is a quick turnaround, a low number of days of inventory. You can see we got down here to around 15 days of unsold inventory. Right now at this time of the year, the lowest you'd expect is 20. The typical is right here at 30, and that's exactly where we are. The worst you'd expect is somewhere up here around 43. Basically because both inventory and offers are in short supply right now, we have a typical speed of the marketplace, which in Santa Clara County, Silicon Valley, is fairly quick. And as you can see, it's at 30 days. So that's what, solidly in that below 40, which I would call a seller's marketplace. Here's your time on the marketplace. Again, the same concept. Now note you're between a cool marketplace up here at something like 20 days and a typical marketplace down here somewhere around 16 days. And we're probably somewhere around 17 and a half days right now. So basically 3/4 of the sellers are selling quicker than 17 and a half days in all three counties. Here we're looking at largest price reductions. So this is the sellers that are the 10% of the sellers that are taking the biggest price reductions. Normally, you'd be up here at about 92.5%. The best you'd really expect to be at this time of the year is somewhere around 93. The worst you'd expect to be is about 90, but instead we're down here somewhere around 89%. But you can see these price reductions are fairly small because just the nature of real estate, you go out knowing what the property's worth, you ask close to market value, and then you make fine-tune adjustments. You're not off by 100% of your asking price typically. But you can see that right now sellers are still taking larger price reductions than they typically do, even though we have the shortage of inventory and the shortage of offers. Here's the average, so same sort of thing. You'd expect the average discount here to be about 99.25%, and that's in a cool marketplace. Typically, you'd expect it to be about 99 2/3 maybe, and in a hot marketplace you'd expect it to be about 99.95, so almost no price reduction whatsoever. And you can actually see that we had a little bit of time when we actually did go above, and I think what it was the bids were so outrageous, sellers were going, hey, let's raise our asking prices, we're just getting way too much interest. So there was a very brief period of time, mostly in 2022, where sellers were actually listing their property and then raising their asking price and not taking care of typos. But you can see it was very short-lived. So again, right here, your price reductions are a little bit greater than you'd expect them to be. Frequency of price reductions, that's right at the worst you'd expect it to be, somewhere around 13% of the sellers taking price reductions, where you'd expect it to be down here around 8%. The least you'd expect is somewhere down around 6%. The reason I'm only going back 5 years is so that you can see a little bit of the change. Each vertical line are the quarter. The bold vertical lines are your new years. So you can see pretty quickly the pattern repeats, where you get price reductions right at the end of the year, very little at the end of first quarter, beginning of second quarter, and then you start ramping up. That's basically where we are right now. It looks like we're having a little bit of a plateau. We bounced up, then down, and then up. So we're basically bouncing along the bottom. So it's normally a V-shaped bottom when you look at the historical data, but right now it looks like we're having a U-shaped bottom. And you can see you had a U-shaped bottom in 2022. You had a very U-shaped bottom in 2021, but more often than not, you have a V-shape. But even coming back here to 2019, that's a little bit of a U. So we're definitely well within the expectations, and you'd expect it to be turning around and going the other way fairly shortly. Here's the Silicon Valley median overbid. This is the point where half the buyers are overbidding less and half are overbidding more, and you're at 2%, which is the least you'd expect. 4% is what you typically would expect, and a little bit of about 11% is the most you'd expect. This is the midpoint. The next slide should be the average. The reason for the average being so much higher is you can go up unlimited amount of overbid as you want. You can't go below 100% and still be an overbid. That's why the average, it's sort of like the average sold price is always higher than the median sold price. Again, the trend right now is up, where the overbidding is returning, but it's cooler than you'd expect for this time of the year. The frequency of overbidding, the same exact repeat. A lot of people will be surprised. Right now, about 64% of the sellers in Silicon Valley, 3 whole counties, are getting more than their asking price. yes, you'd expect it to be up here around 75%, and the most you'd expect is up around 85, but still for 2/3, 2 out of 3 sellers to be getting more than their asking price is pretty amazing. This is the sold price over the long term. It's on log scale paper with me hand drawing in each $100,000 increment. So the line here is your rate of appreciation, and that's just freehanded, so it could be off a little bit. When the line, which is the current data, is above the expectation line, you actually have downward pressure on price. And so you can see that at the end of the year, we had upward pressure on price, and we still do right now because we're a little bit below. But again, you can see the dip down at the end of every year, which corresponds to that second slide I showed, where the affordable areas become a larger percentage of the market share and the expensive homes become a smaller percentage of market shares. So this is sold price, yes, and it's accurate, but it's not reflecting actually what's happening to property values of a given property. Here's your active inventory, and now what we're looking at is, instead of Silicon Valley all blended together, we're looking at the 3 counties separately. The blue line is Santa Clara County, the orange line is San Mateo County, and the gray line is Alameda County. And you can see they all follow the trend fairly similarly. But the big takeaway, in my opinion, is you come back here to basically little past first quarter, and Alameda County was at 1,400 homes. And you can see that that's not an unreasonable number for this time of the year for Alameda County. Where's Alameda County? At 600. That just gives you an idea of how dramatic the shortage of inventory is. Santa Clara County is not as dramatic, but still pretty significant, because it starts off at maybe around 1,200 and is currently at the same level as Alameda County. San Mateo County, on the other hand, is almost completely normal inventory. You come back here, you may be 400. Here you're less than 400, so maybe call it about 400. And where are you? You're at 400. So San Mateo County has reasonable inventory, and it's Santa Clara County and Alameda County that have this huge shortage of inventory that's causing Silicon Valley to have its shortage. So if you looked at the shortage of these counties, Santa Clara County and Alameda County, that would be more pronounced than the shortage for the whole Silicon Valley, because San Mateo County is break even. Here's the number of offers accepted, the same trend. San Mateo County, though, now you'd say maybe somewhere around 600, 500 offers is what you'd expect, and now it's only around 300. So San Mateo County has the normal number of listings, but has less offers accepted, so it's in a slower marketplace. Santa Clara County and Alameda County, very similar. Alameda County is typically a little bit bigger, but right now they're right on top of one another, maybe somewhere around 1,200, and now in some number around 775. Days of unsold inventory. You can see that Santa Clara County and Alameda County are faster at below 30. San Mateo County is the slowest of the 3 counties, and that is pretty unusual. Normally, San Mateo County is the fastest of the 3 areas, and this is because it's the most desirable. And you can come back and even see the orange is basically at the bottom through all this. And when did it change? It changed right here at the peak, which is COVID. So, right after COVID, it came out slower. Then it rebounded and sort of was even when the market was on fire. But now that we have some time again, it's coming out on the top. It's definitely not the low one. So that's a long-term shift that we've experienced from COVID, most likely. Days on market, very similar. You can see San Mateo County now is pulling up a little bit, about 23 days, 22 days. So 3 weeks to sell your 75th percentile seller. Well, Santa Clara County and Alameda County are probably down here somewhere around 17 days. So a little bit of difference, consistent with San Mateo County being the slowest. Here's your price reductions from the seller prior to offers. You can see San Mateo County is taking 3% price reductions. Santa Clara County and Alameda County are taking almost no price reductions. So you can see there's clearly a difference between how the 3 counties that make up Silicon Valley are acting. The same thing happens within Santa Clara County or San Mateo County. The micro markets within each one of those counties is acting different than the county as a whole. This is your sold price to list price average. So this is your overbid, and this is the magnitude. So Alameda County is by far the best up here at something like 108%. And that's the affordable. That's the new hot place. I don't have to go into work every single day, so I can go out and buy in Alameda County and get more house for my money. Santa Clara County is next, and third is San Mateo County. Frequency of overbidding, same order, a little more distributed, especially between Santa Clara County and San Mateo. But in Alameda County, 70% of the sellers are getting more than their asking price. Santa Clara County, it's about 62%. And in San Mateo County, it's barely at 50%. Here is looking at prices going back over time. It is noteworthy right here. There was a period of time where Santa Clara County and San Mateo County were the same price. And 1 week, if I'm remembering correctly, San Mateo County was actually $20,000 less expensive on median than Santa Clara County, which is very unusual. It's the only time I'm aware it happened. Typically San Mateo County is more expensive, but now you can go back. And the reason to go back is when you're having big spikes like this, it's really hard to tell what the price is. So you come back for more stability. So you'd be right here, third and fourth quarter third quarter plus a month of 2022 is basically where the prices are back to. But you can also then do a ratio when you have stable prices. But the takeaway, in my opinion, is prices in San Mateo County are below where they were in 2021, and they're above where they were in Santa Clara County. So Santa Clara County right now is above where we were in 2021, where both Alameda County and San Mateo County are below. So there's a contradiction there or a difference there. This is the same graph, but on regular paper instead of log paper. And this is the appreciation over time. You can see San Mateo County is doing the least appreciation, Alameda County the next, and right now Santa Clara County is getting the most appreciation at 180%. So 80% appreciation over the last 9 months of 2015. Here's the actual data that makes up the part of this presentation. You have the 3 counties, so if you want to look at them, number of new listings. I actually think, and I don't know why, this number from last week I think was wrong, because it was a 20% drop from the previous week, and now it's a 17% gain. And this is a 5-week period, and there's no way you can have a 20% drop in a 5-week period of time. That would be essentially 1 week with no listings, and there's no reason no listings would have come on the market last week. So I think for some reason this data is wrong, but I suspect that data, so this 17% increase in new listings is not something to be worried about. The market's not getting flooded, because it's just reflecting the 20% drop I had last week. This is the number of total listings. These numbers are consistent. So what's inventory? So inventory in Santa Clara County is down a little bit, up quite a bit in San Mateo County, 11%, up a little bit in Alameda County. Number of offers accepted, basically they're up across the board, 2.4% overall. DUI, pretty stable. I consider anything under about 5 days in a week to be just shifts in marketplace. At 3.7, I would start saying that there's a potential that San Mateo County might be slowing down, and raise the awareness and pay attention. And then the closings are a lagging indicator, but you get sold price, so you can see the overbidding and how it varies, with San Mateo County being the least. You can see the frequency of overbidding down here at 64%, 55, 70%. So you can just look at the different numbers and get a specific idea. This is now Santa Clara County single family homes only, and this is April data, which is normally gathered on May the 6th. For the current year, it's only through midnight last night, and I don't think I updated that. That should be the 29th, today's date, and I think it says the 23rd. Basically, this is the best you can do. The reason you do this is you're trying to figure out what the market's doing, what the takeaways are, and one of the takeaways is 603. The only year that I could find that had less inventory was last year. Every year, so that's your limited inventory. This is DUI, so low numbers are fast. It's slow compared to the last couple years, but you just come back to something like 2010 and it becomes a very reasonable number. Selling everything out in 26 days is a fast-paced marketplace. So Silicon Valley or Santa Clara County single family homes only. For those that want to compare apples and apples, you have to go back to March. There it is for you. This is the record low volume of sales, and I am playing around with the data a little bit because I'm not putting in 2020 data. It's down here for those that want it. So, and that's why these numbers are the 9th lowest number of offers in the last 10 years and the 24th lowest numbers. I'm taking all that into consideration. The reason I wanted to delete these is not to play with numbers, but to show the percentage of of low. If I put this in, it would jump up to 100%, over 100% of the record low. And I think we'll all acknowledge that the pandemic, when we couldn't even show properties, was an exceptional event and really isn't a normal marketplace. And so therefore I feel comfortable deleting it. I think this is a better way to present the data, and I just want to be very clear what I'm doing, because one of the things people that do report data and statistics, they can play with the data and make it pretty much say anything they want. My goal is to make the data reflect what the market's actually doing, and I think making that correction by not showing the pandemic year is actually improving the value of the data. So now what you're doing is looking at the three components, looking at a ratio. So inventory, we've talked about being low. It's basically somewhere around 64% of where you'd expect it to be. The gray black line up here is where you'd expect it to be. The number of offers you'd expect is a little bit higher, somewhere around 70%, maybe 68%, causing DUI to be lower, which means the speed of the marketplace is actually faster. Things are selling. So your DUI is only about 93% of where you'd expect it to be, which is a faster marketplace than the 10-year median. Everything on here is based on the 10-year median. If you're having a very typical 10-year year, you'd be right on the black line. Here's the recap of every data. I'm just throwing that up for one more time. We already looked at it. This is the URLs that we went to. We've already explained that. Now we're going to move on away from Silicon Valley and look at the Greater Bay Area. The Greater Bay Area includes 13 counties. I add in 5 regions. So you have Silicon Valley as a region, the cities, which is San Francisco and Marin, not really a good name because Marin really isn't a city. Then you have the North Bay, Sonoma, Napa, Solano, and Contra Costa, Central Valley, and Central Coast. We're doing the reverse order by presenting the data first. So here's all the raw data, and now we'll get into the presentation of that data. So here's your active inventory, and you can see that your other regions are the same thing. You can start up here and look at Central Valley and the North Bay. They normally would have just shy of 5,000 listings, maybe pick 4,500 for more recent years, and their numbers are down around 1,800. Clearly a shortage of inventory across the board, not as dramatic in the San Francisco, the cities, and the Central Coast, but they're also smaller areas. On a percentage drop, it's probably similar. Here's the number of offers accepted. Same concept. You'd normally expect to be somewhere around 2,500 for the big 3 groups, and instead you're somewhere around 1,800. The smaller 2 regions are also down off of where they've historically been, but they don't appear to be as much. Days unsold inventory. Here you can see that Silicon Valley has normally been way below the other regions. Now it's sort of blended in with the North Bay and the Central Valley all together, and the cities and the Central Coast being a little bit slower, but still very reasonable. Here's your 75th percentile. Here you can see Santa Clara County sort of takes the lead, followed by San Francisco, Marin, and then the other 3 are right on top of one another and hard to distinguish. This is median days on marketplace. I don't particularly like this data, but it's there just because for completeness, I guess. This is the 10 percentile price reduction. It's all over the place. You can see the cities is coming down here and having the biggest. The least is the gray line, which is the North Bay. Silicon Valley is sort of right in the middle of the pack that's doing particularly well. Here's your average price reductions. Again, same concept. You got the Santa Cruz doing the biggest price reduction, Silicon Valley doing the least. This is the overbid. The biggest overbid is actually San Francisco. So they were doing a little bit not so well on some of the other things, but they're having the most overbid, followed by Silicon Valley, followed by the North Bay, followed by Central Valley, followed by Monterey, the Central Coast doing the least. So you have the 5 regions consistently. This is overbidding. Central Coast is basically having no overbidding. It's hard to say, but I think this is just the Silicon Valley and San Francisco Marin are the only 2 that are getting overbid, and they're right around 102% on median. This is the smallest overbid amount. So this is your underbids, in fact, because the people that are, most of the time this would be underbids. It's the 10% of the seller buyers that what their overbid ratio was. So here they're below 100%. So they went in on their offer below the seller's asking price. Here's the largest overbids. So the other extreme, where what 10% of the buyers are overbidding the seller's asking price by the most. And you can see San Francisco and Marin's the highest, followed by Silicon Valley. You can see the patterns repeat no matter what data point you're looking at. The frequency of overbidding, same order. And this is total appreciation. Here you can see San Francisco and Marin have had the worst appreciation. The best appreciation is in the Central Valley. Again, the commute is one aspect. And with that, we're back to the URL table, and I'm open for any questions. Not seeing any unmuted mics. Have a good week, everybody. Take care. Bye for now.